If you're a first-time homebuyer planning to buy in 2026, the Big Beautiful Bill quietly changed a few things. And regardless of your situation, if you're planning on buying this year, these are things that you should definitely be aware of. Hey everyone, my name is Taylor Ratliff and this is Moving to Colorado. And if you are somebody that is looking to move to the state in 2026, I would love to help you. Make sure that you subscribe, like, and hit that bell so that you can stay up to date every single time I make another video. And let's dive right into all of the changes that are happening, all of the implied changes that are happening now that the Big Beautiful Bill is passed. Okay, so the technical name for the Big Beautiful Bill is HR 1. So we're going to get into a couple of the misconceptions that a lot of people have when talking about HR 1, and then what HR 1 actually does. And then we're going to get into all of the different points and how it's affecting home buyers in 2026 and really break it down into bite-sized pieces so that you can truly understand what this means for you if you're thinking about buying a home in 2026. So what even is HR 1, especially when we're talking about the housing market? So HR 1 is the one big beautiful bill, and it's primarily a tax and fiscal policy bill, not a housing program. And this is very important. Three things that actually matter here is that HR 1 reduces macro level economic uncertainty. Number 2, it stabilizes long-term tax treatment for businesses and investors. And 3, it signals no emergency housing intervention is coming. None of these things say that builders must offer incentives or lenders must offer programs, but all three of these things change behavior. There are three common misconceptions that most first-time homebuyers have when it comes to HR 1, and that is that this bill is going to lower home prices, it's going to make home buying easier, and it's going to automatically help our first-time homebuyers. And this just isn't the case. The reality is that it doesn't directly change prices, but it does change the conditions around buying a home in 2026. All right, so let's hop into what those conditions are and what it actually means for you if you're considering buying in 2026. In the mortgage and lending environment, the bill does not change lending rules, but it does change lending confidence. And this distinction matters significantly. And here's the reason why. The one big beautiful bill is signaling economic stability, not a housing market crash. And so when lenders are pulling information to see if you'll qualify for a home, they are not just looking at your credit score, your income, and your debt. They're actually also looking at economic risks, policy stability, and whether or not the market feels volatile. And so when big federal legislation passes like this without triggering financial panic, it's sending a message to all of the banks. And that message is that this is not a systemic collapse moment. That doesn't mean that everything is great, but it does mean that we're not having any emergency shutdowns, there's no credit crisis, and there's no sudden tightening across the board. So lenders as a whole are not bracing for impact anymore. And this is good for you if you are a first-time home buyer. It's important for you to understand how lenders truly react to stability. And so when lenders feel uncertainty, they do something called credit tightening, even if nothing officially changes. And what that looks like is pulling loan programs quietly, raising overlays, and saying no more often just to be safe. And when stability returns, this reverses slowly. And what that looks like is lenders having more competitive loan programs, not risky loans, but more options. So more conventional loan offerings, better rate options for strong borrowers, and builders' preferred lenders being more aggressive. So this is about choice, not necessarily shortcuts. What we are seeing here is gradual loosening, not free-for-all lending. And this is key because we're not talking about no document loans. We're not talking about bad credit approvals. We're not talking about 2008 style lending that's going to lead to a market crash. But what we are talking about is slightly more flexibility on debt to income ratios, reserve requirements, and layered risk, which means that good credit can offset other factors. And so think of it as we'll consider this file, not absolutely no, not going to consider it, the market is too risky. So definitely is opening doors for you if you are a first-time home buyer in 2026. When it comes to mortgage and lending, this is what has not changed for first-time homebuyers. So even with improved lender confidence, as a first-time homebuyer, you must still have solid credit. And this doesn't mean perfect credit, but patterns do matter. You want stable income. Lenders still want consistency, predictability, and proof that you can pay for this house that you want to buy. And realistic budgets. No one is approving buyers for fantasy numbers. So it's important to be realistic because the guards are still going to be there, which is truly going to protect us from another crash. This bill does not equate to shortcut loans, but it does mean that there will be fewer freeze-ups from lenders. All right, when people are speaking about down payment assistance and savings pressure in relation to HR 1, what are they actually talking about? Let's get into it. Big picture first, this bill does not hand first-time homebuyers money. This is important for you to know. There is no federal down payment grant, no national first-time homebuyer fund, and no instant affordability fix. So first-time homebuyers, you still need to save the old-fashioned way. That's the starting point. And while each state is going to differ, and if you're in Colorado, definitely reach out because we do have CHFA and different down payment assistance programs that will actually pay your 3.5% down payment in order to get you into a property. Happy to share more. You do need to have a down payment, and this bill does not take away that requirement. What the bill did, though, was stabilize inflation pressure, which means that your savings are stretching further. Sounds a little complex, so let me break it down for you. What this means is when inflation is high, your groceries are going to jump, insurance jumps, utilities jump, your rental rates are jumping fast, and that is going to eat into your savings. When inflation stabilizes, even if the prices are still high, costs rise more slowly, budgets become predictable again, and savings stops feeling like running on a freaking treadmill. So you can start to catch up. So while the bill didn't lower prices, it did reduce the absolute chaos that makes saving feel absolutely impossible. So it didn't lower prices, but it stopped the chaos when it came to inflation. Savings pressure is a real thing, and with rental prices continuing to grow, it means that it's harder to save if you wait to buy a home. And what I mean by this is that a lot of first-time home buyers are actually falling into the trap of, I'll wait one more year so I can save more, or I'm gonna wait 2 more years so that I can save for a bigger down payment, or I'm gonna wait longer so that I can have better interest rates. Whatever it is that is causing you to wait, it's actually costing you more money for you to wait to buy a home. And what I mean is that in the 1 year that you are waiting to buy a home so that you can save more, in that year, the rent increased, the renewals for that rental unit increased, fees went up, and moving costs repeat. And so even small rental increases matter. And an example of this is if your rental property that you are leasing goes up by $200 a month, multiply that, $200 times 12, and that's $2,400 that you're missing out on savings every single year that you're waiting to buy a home, when there's programs, especially in Colorado, that can get your foot in the door right now. And we're also in an extreme buyer's market, and so it's an insane time for you to negotiate and to get the seller to potentially pay for your closing costs or HOA dues or concessions to buy down rates, all while having a down payment assistance program that is funded by the state help get you in with your down payment. So if you want to buy a home, there's no reason for you to wait and to think that you're doing yourself any favors by waiting another year. Reach out for help because you might be costing yourself way more money by waiting than you would if you got your foot in the market right now, got into a starter home, and within 2 years you're able to sell, avoid the capital gains taxes, and actually get into the next property that you really want to be in. So if you are wanting to buy a home, but you're thinking about waiting another year or 2 years because you want to save more, reach out. Let's have a conversation to see if that is actually something that's going to serve you, or if buying a home now and getting started is something that is going to be better for you. Here is where most first-time home buyers lose ground. They're waiting for the perfect market in the perfect year, the perfect timing, and that just doesn't exist. There's never going to be the perfect year where there's no rates, no competition, no risk, and no uncertainty. That year doesn't exist. Every year is going to have a trade-off. It's going to have the pros and cons of the market that year. And in 2021, we had insanely low rates, but there was crazy competition that had everybody doing multiple offers and over asking, making it insanely unaffordable for first-time homebuyers. And then in 2023 and 2024, 2025, we had higher interest rates, which made it less affordable for people again, but better terms that were more favorable for people. And then in 2026, this is the year where you want to get strategic and you want to have a local expert that is on your side so that you know how to enter the market and negotiate for the best terms possible for your situation. So make sure that you know that waiting doesn't remove the trade-offs. It just changes them. And so it's important to have a conversation with somebody that understands the market so that we can really figure out, what are you looking to do? Where are you at right now? What is everything that we need to do in order to get you to where you want to be? And when is the right time to do that? And oftentimes it's not in alignment with what the market is doing. It's in alignment with what is going on with your life, and things tend to happen. Real estate is really quick. And so we want to make sure that you're prepared for anything and everything, because timing the market is not a thing. It doesn't work out for you. And everybody that times the market says, I wish I would have bought sooner. Don't let that be you. Reach out and let's have a conversation about it. Before I get into the next point, I want you to think and really consider the thought of paying rent for another 12, 24 months, maybe even 36 months, 1 to 3 more years of renting a property that is not yours. These are the things that nobody is going to talk to you about, and that's that it is 100% interest. Paying rent on a property that you do not own is 100% interest. So why are you waiting for interest rates to drop when you are paying 100% interest in the place that you are at right now? That makes absolutely no sense. The other thing is that you have absolutely no equity. So as property values continue to increase, you're not making any equity because you don't own your property, and you're just going to be paying more every single month because the property that you live in is worth more and the person that owns it is now going to charge more. So you are paying 100% interest, you're not making any equity, and there is no upside if the market improves. If we see a huge increase in the market, you don't have any financial benefit because you are still renting. So definitely something to consider. There is a ton of pressure when it comes to savings, and there's a ton of pressure when it comes to down payment assistance, but there's still options for you, and there's still pathways for you to get an incredible deal in this market as a first-time home buyer. So definitely reach out. All my information is up here. Whether you're in the Colorado market or any state in the country, I can get you paired up with an agent that can help you. But let's have a conversation about what it looks like to entertain buying in 2026 instead of continuing to rent. It's important to understand that waiting doesn't always help first-time homebuyers, and oftentimes it's going to delay you. And the big beautiful bill, it didn't create down payment assistance, but what it did do is stabilize the environment people save in. And the problem for first-time homebuyers is that while they're waiting for the perfect year, rents keep rising and home prices keep rising. So even if prices don't jump, the cost of waiting does. And that's very important for you to understand as a first-time home buyer, because the longer that you wait, the more money you can end up costing yourself. Okay, how is HR1 and new build incentives connected? The connection is behavioral, not legislative. And you want to think of the bill as changing the weather, not moving the furniture. So it's more of an influence instead of a direct change. And what I mean by that is HR1 signals stability. And so this means that builders are starting to plan forward. Most large builders operate on multi-year timelines, credit facilities, forward sales targets, and investor expectations. So when HR1 passed without triggering any emergency housing policies, it told builders that we're not entering a crash response phase. And that matters because builders don't freeze projects, they don't halt starts, and they're not going to slash prices dramatically. But instead, what they do is they focus on moving inventory strategically. And so builders are going to protect pricing, but their incentives become the lever. HR1 did not lower mortgage rates, it didn't subsidize buyers, it didn't mandate affordability programs. So builders can't rely on the government to stimulate demand, but they can rely on their own incentives to stimulate demand and move the market forward. And what I mean is they keep prices stable to protect comps, and they use off-price incentives to close deals. This is why you see things like rate buy downs, closing cost incentives, and preferred lender packages, is because they're trying to offer you an incentive to get more traction, get more interest in their properties and get them moved, because they can't just stop projects, they can't just stop what they're doing, and they also can't slash their home prices significantly because it's going to ruin the market. So what they have to do is they have to compete, and they have to be competitive and attractive to buyers that are looking. And the way they do this is through rate buy downs that are going to affect your monthly payment, or closing cost credits that are really attractive to those first-time home buyers, and then preferred lending packages that kind of wrap all of that into one if you use their preferred lender. It's important to know that HR1 affects incentives indirectly, because incentives are the response to a stable but slower market, not HR1 directly. HR1 also supports capital markets, which means that builders are going to keep building. HR1 preserved business tax structures, reduced fear of sudden policy reversals, supported continued lending to large developers, and that all kept construction loans flowing, builder pipelines active, and inventory coming online. So when inventory exists, builders need to sell it. And that's where incentives come in to help move that inventory along so that the builder can stay in business, the first-time home buyers can continue to buy, and they can continue to build those new homes. Downstream effect is why this shows up as an opportunity for first-time home buyers in this market. And it's important to understand this because HR1 did not bail out first-time home buyers, or any home buyers for that matter. It didn't create any grants, and it also didn't artificially spike demand. And builders are still left solving their own problems and thinking to themselves, how do we move homes in a cautious buyer environment? And the answer to this question is that they need to reduce the cash needed, they need to reduce monthly payments, and they need to simplify the process, and they do this through incentives. It's important to understand very, very clearly that the big, beautiful bill, HR1, did not create incentives. It did not make builders more generous, and it did not make new builds cheaper by law. Instead, HR1 stabilized the system, and builders are adapting inside of that system. So, very, very short, HR1 is influencing the stability of the market, and builders are responding to that stability with incentives that are helping move their inventory out of the market. HR1 didn't create builder incentives, but by stabilizing the economic and tax environment, it pushed builders to compete for buyers instead of waiting for the government to bail them out. It's very important to understand HR1 and its relation to the trap that a lot of first-time homebuyers find themselves in, and that is the wait for rates to drop trap. Many buyers, and I might be talking to you, are waiting for lower rates and for the bottom. And here's the thing that most people don't understand is that when we hit that bottom, or when rates do drop, competition is going to rise, and oftentimes the prices start to rise quicker than the payments lower. And so even though we have those interest rates that are lower that lead to a lower monthly payment, the price of the home has jumped so much because of competition and buyer demand that it doesn't matter. And it would have been a better market for you to entertain when rates were high and you were able to get concessions to negotiate and to do things like rate buy down. So a lot of people are waiting for the market to fall out and for rates to drop, and don't understand that everyone is waiting for this. And when that happens, when we see even the littlest difference and dip in rates, there's so much new competition that it doesn't even matter that we saw that dip, because the home prices go up. So it's very important to understand that just because you have a lower rate doesn't mean that you have a lower payment, because the value of the home could have gone up due to competition. When it comes to mortgage rates, H.R. 1 does not set these rates, and it does not affect these rates either. The Federal Reserve and the bond markets do. And so the bill is not going to lower rates. The bill does not cause rates to fall, but instead it explains how buyer behavior changes once policy uncertainty is removed. And that is where the trap shows up. That's what H.R. 1 actually changes indirectly. It reduces uncertainty around taxes and fiscal policy. It signals stability, not emergency intervention, and it removes what if something big breaks fear. And that matters because buyers don't wait for just rates, they wait for clarity. After H.R. 1, buyers are feeling more confident about planning their future home buying. Fewer people are sitting on the sidelines just in case the market falls out, and more buyers are ready to jump the moment rates improves. And so H.R. 1 doesn't move these rates, but it loads the spring, quote unquote. Waiting for rates backfires after stability, and this is the trap. Many buyers think to themselves, once rates drop, that's when I'll finally buy. But after H.R. 1, there's no crash narrative, there's no emergency housing freeze, and there's no reason for lenders or builders to panic. So when rates dip even slightly, pent-up buyers are going to flood back into the market. Competition increases fast, so fast, and inventory gets absorbed very quickly. And this is especially true in places that are lifestyle states, destination states like Colorado, and new build corridors and entry-level price points. So it's very important for you to understand, as a first-time home buyer, or as a home buyer in general, if you are waiting for rates to drop for them to decline in order for you to jump back into the market, so is everybody else. And so you better get ready, because competition is going to go up, demand is going to go up, and those home prices are going to go up. And so truly, it's often that we see that people that enter the market in a less favorable time than what people are seeing on the news, that they're actually getting better deals and better terms. And in this market, we're in a buyer's market in January of 2026. And what that means is that sellers are negotiating, and they're paying closing costs, and they're paying HOA dues. And we're able to use concessions to do rate buy downs to save you monthly. So even if the rate is high, there's ways that we can get the rate to be bought down and for you to have a lower interest rate, even though the rates are high. So there's no reason for you to wait. Waiting is going to cost you more money in the long run. And if you have questions about how to get a lower interest rate in this current market right now in January of 2026, reach out, because this market might be way more favorable to you than a market that has lower rates but way more competition. So to wrap things up on when we're talking about mortgage rates and how the H.R. 1 bill affected those rates, H.R. 1 didn't change mortgage rates at all, but it changed buyer confidence. And when confidence returns before inventory does, waiting for rates often backfires. So again, make sure you reach out and have a conversation so that we can really take into consideration every aspect of your situation so that we can truly determine, is it in your best interest for you to wait for rates to go down? Or are there options that are going to be favorable to you? And can we get you into a home with great terms and with a quite decent amount of money being paid to you or for you for different things by the seller in this market? So definitely reach out. The one big beautiful bill did not affect mortgage rates, but it did affect buyer confidence, which is going to change the market. As a first-time homebuyer in 2026, it's important for you to know that HR 1 is not going to fix housing, it's not going to make homes more affordable, and it's not going to change everything for you. This is simply just not true. And if you're reading headlines that say so, then they're lying to you. HR 1 does not guarantee affordability. It doesn't cap home prices, it doesn't lower mortgage rates, it doesn't subsidize buyers directly, and affordability is still going to be driven by local supply, demand, wages, rates, and price points. So buyers are still going to have to solve affordability locally, not federally. The government is not going to reach in and bail us out. I know everybody was wishing for that in 2026. It's not a bailout, but it is influencing the behavior to make it more attainable for you in 2026. The big beautiful bill does not eliminate risk, and so it's not going to remove market corrections, job changes, lifestyle mismatches, overbuying mistakes, and every market cycle is still going to have its trade-offs, timing risks, winners, and losers. That's just the way that the market is. That's the way that the market will always be. There's always going to be somebody that's winning out and always going to be somebody that's losing. And that's why it's important for you to reach out to a professional that understands how to make sure that you come out on the winning end when it comes to the real estate market. And the bill is not going to protect you as a first-time home buyer from bad decisions. So reach out so that you have proper guidance. The biggest misconception I want to say that I hear lately is that the big beautiful bill does not mean that you should wait to buy a home in 2026. It does not mean that if you wait, prices are going to be more affordable in 2027 or 2028. It doesn't mean that if you wait that things are going to get more affordable for you, or that the government is going to come in and swoop in and bail you out, or they're going to offer incredible rates for you. That's not going to happen. This bill does not signal you waiting. HR 1 didn't promise future relief, it didn't signal that prices are ever coming down in the future, and it didn't tell buyers to pause. So waiting because of the bill just doesn't make any sense at all. It makes no sense. The bill didn't create a countdown clock, but buyers did. So what this means for you as a first-time home buyer actually is that even after HR 1 was passed, first-time homebuyers still must use local market strategy. Hello, me. Reach out to me as a resource. I'm here to help you. I'm here to help you navigate this Colorado market, and I'm here to get you in touch with the agents that you need to get in touch with if you're navigating other markets as well. So this is what HR 1 did for first-time homebuyers specifically. Even after HR 1 passed, first-time homebuyers still must use local market strategy. That's why it's so important for you to reach out to a local market expert so that they can help guide you through this market and how to get the best deal possible. Whether you're a buyer, seller, investor, whatever that is, you still want local expert help. So hello, reach out to me if you're trying to move to Colorado. And then if you're trying to move to a different market, reach out as well, because I'm connected with a ton of incredible partners across the country, and it's truly important to work with somebody that understands how to manipulate this market and how to manipulate interest rates and how to really get you the best deal possible in this market, because it's available to you as a first-time home buyer in this market. You also still must compare financing options, because there's going to be builder incentives, lender programs, state programs, buy downs, and none of this is automatic. You have to ask, you have to make sure that it is something that you qualify for, and you want to make sure that you have help navigating that. So again, on leveraging local help reach out to a realtor, reach out to myself if you have questions, because we can help you navigate not only the cities, but also the programs and the different ways that you are going to enter this market as a first-time homebuyer in 2026. First-time homebuyer, you're also still going to have to match your lifestyle to your budget. Buying a home that just works on paper but breaks daily lifestyle is still a mistake. You're going to end up having buyer's remorse, and you're going to end up selling your property before it makes sense for you to sell your property. So make sure that as a first-time homebuyer in 2026, you're using local market strategy, you're comparing your financing options, and you're matching that lifestyle to your budget. This is very important. This is what our smart first-time homebuyers are doing in 2026 and what you want to make sure that you're doing as well. So our smart and savvy first-time homebuyers, they're not buying when headlines feel safe. They're buying when the math works. And it's important for you to know that at any point, you're going to find headlines that scare the absolute shit out of you as a first-time homebuyer. It gets scary when you start looking at the headlines. And so don't feed into the fear-mongering, and truly reach out to somebody that does this and has success stories and can really help guide you in a way that feels attainable and possible and enjoyable, and not one that scares the ever-living but Jesus out of you and makes you never want to buy a home ever in your life. So that's not the vibe here. We are not listening to crazy headlines. We're actually listening to the facts. We're listening to market data. We're listening to real information that exists, not just emotions, not just feelings. And we're buying when the math works. Smart first-time homebuyers are asking themselves, can I afford the monthly payment? That is what matters. Your purchase price doesn't matter, because if you can't afford the monthly payment, you're never going to pay off the purchase price. You're going to lose the home. What matters is, can I afford this monthly payment? They're also asking, do incentives offset today's rate? And I can tell you in Colorado, they 100% offset it. If you have questions on how to use rate buy downs to manipulate your monthly payment, definitely reach out, because that's when things get fun, and that's when we can really bump up your pre-approval and start looking at homes that are more along the lines of what you actually want to buy while still having a lower monthly payment. And our smart first-time home buyers are also asking, does this home fit my 2 to 5 year plan? Because if it doesn't, you're going to sell, you're going to lose out on money when it comes to listing fees and closing costs, and it truly doesn't make sense for you to buy a home if you're planning on selling within 2 years. It doesn't make sense for you. And so if you're kind of having concerns on what that looks like or how to figure out if this is a good idea for you, reach out. I'm happy to be a resource for you and to really help you decide, should I keep on renting, or should I make the best decision for my finances and move forward with an investment into real estate? Our smart and savvy first-time homebuyers are using their incentives very creatively. They're leveraging builder rate buy downs, using closing cost credits, and negotiating terms instead of price. And this matters because HR1 didn't stimulate demand, builders had to. Our smarty pants first-time homebuyers are also choosing location and lifestyle over hype. So they're prioritizing their commute, daily routine, long-term livability, and not just TikTok cities and the fad national rankings or fear-based narratives. So it's very important that you do research and that you make sure that the place that you're choosing is going to suit you long-term, because that's going to lead to your long-term happiness here and long-term thriving in the state that you choose. I think it's so important for you to understand that the perfect market is never going to exist. Every year has a catch, a cost, a compromise, and waiting doesn't remove the trade-offs, it just swaps them. And so timing strategy is always going to beat timing fear. Smart buyers are not asking, is this the bottom of the market? They're asking themselves, is this the right move for me? Is this the right time for me? Is this the right home for me? Is this the right city for me? Is this the right place for me right now with the tools that I have available is this a good decision for me? That's what they're asking. And that is going to be the winning mindset for first-time home buyers in 2026. HR 1 didn't make buying easier or any harder. It made clarity more important. And first-time homebuyers who focus on strategy instead of headlines are going to be the ones that actually win in the 2026 market. Right, so that was the one big beautiful bill, HR 1, and how it applies to the housing market and how it applies to you as a first-time homebuyer. So if you have questions on how this all breaks down for your situation specifically, reach out. I would love to help you. That is what I do. I'm here to be a resource. And then specifically, if you are looking to buy a home in the state of Colorado, we do have our own incentives through builders here and through different state programs, down payment assistance programs, and different programs that are truly going to help you leverage what is already being offered to you as a first-time homebuyer so that you can really make your jump into the market as just the best experience that you possibly can, and hopefully save as much on it as possible. And so if you have questions on how to make that possible for you in 2026, reach out. All my information is on the screen right here. And then like, subscribe, hit that bell so that you can stay tuned every single time I make another video. And happy 2026, everyone. I hope that everyone that is looking to move to Colorado does so, and everyone that is looking to buy their first home in 2026 does so as well. Cheers.